qu'on le pensait. Et troisièmement, on a besoin de taux d'intérêt plus élevés. Le taux directeur est notre principal outil pour maintenir
The benchmark interest rate is our main tool for maintaining an economic balance and maintaining the goal of 2%. We've raised that by half a point today to bring it to 1%. As we have already indicated, Canadians should expect another increase.
Main messages in English. First, the Canadian economy is strong. Overall, the economy has fully recovered from the pandemic and is now moving into excess demand. Second, inflation is too high. It is higher than we expected, and it's going to be elevated for longer than we previously thought. And third, we need higher interest rates. Our policy interest rate is our primary tool to keep the economy in balance and bring inflation back to the 2% target. This morning, we raised our policy rate 50 basis points to 1%, and we indicated Canadians should expect further increases. Let me expand on each of these three themes. Recent data suggests the Canadian economy weathered the Omicron variant remarkably well, and the economy has considerable momentum going into the second quarter. A broad set of indicators suggests that our economy is now moving into excess demand. The labor market shows this clearly. Job growth has been strong, the unemployment rate is at a record low, job vacancies are elevated, and wage growth has reached pre-pandemic levels. And businesses are also telling us they expect they'll need to increase wages further to keep and attract workers. Looking forward, momentum in most major spending components points to strong GDP growth this year. Canadians are spending more on services as public health measures ease, and spending on goods remains solid. Housing activity has remained strong and is expected to moderate, but to still elevated levels. Business investment and exports are both picking up, and higher prices for many of the commodities Canada exports are bringing more income into the country. Higher interest rates should moderate growth in domestic spending as we move through this year and next. At the same time, Canada's productive capacity should be helped by robust investment, improved labor productivity, and higher immigration. Putting all this together, the bank forecasts the Canadian economy will grow 4.25% this year before moderating to 3.25% next year and 2.25% in 2024. The bank's primary focus is inflation. We are acutely aware that already high inflation has risen further above our target. The invasion of Ukraine has driven up the prices of energy and other commodities, and the war is further disrupting global supply chains. We're also concerned about the broadening of price pressures in Canada. With about 2/3 of CPI components growing above 3%, Canadians are feeling inflation across their household budgets, from gas to groceries to rent. CPI inflation hit a three-decade high of 5.7% in February, above what we projected in the January Monetary Policy Report. We now expect inflation to average almost 6% in the first half of 2022 and remain well above our 1% to 3% control range throughout this year. We then expect it to ease to about 2.5% in the second half of 2023 before returning to the 2% target in 2024. With inflation broadening and remaining higher for longer, the risk is that Canadians start to think that high inflation will become entrenched. This leads me to my third point. Interest rates are increasing. Raising the policy rate is our main tool to moderate demand, prevent a persistent buildup in domestic price pressures, and keep inflation expectations moored on the 2% target. The economy can handle higher interest rates, and they are needed. Increases in the bank's policy rate raise the interest rates that banks and other lenders charge their customers. These include rates on business loans, consumer loans, and mortgage loans. With increases in the policy rate, interest paid on savings products will move up as well. By making borrowing more expensive and increasing the return on savings, a higher policy rate dampens spending, reducing overall demand in the economy. And with demand starting to run ahead of the economy's supply capacity, we need this to happen to bring the economy into balance and cool domestic inflation. We also need higher interest rates to keep Canadians' expectations of inflation anchored on the target, so that as global inflationary pressures from higher oil prices and clogged supply chains abate, inflation in Canada falls back towards the target range. We are committed to using our policy rate to return inflation to target, and will do so forcefully if needed. Let me now say a few words about the Governing Council's deliberations. On a bien sûr parlé de l'impact économique de l'invasion de l'Ukraine. La guerre a fait monter les prix de l'énergie et leur volatilité. Elle a aussi perturbé les échanges commerciaux.
It has affected trade, increased uncertainty, and created volatility in financial markets. This is going to weigh on economic growth across the globe, especially in Eastern Europe. The impact on growth in Canada should be low for two reasons. One of those is that our economic ties with Ukraine and Russia are limited. Second, even though the war has reduced growth worldwide, what it has done is increase demand for basic products that Canada exports, such as oil, potash, and others. We've also discussed the impact of higher inflation on Canadians. Canadians expect that inflation will remain high for a while, but they are expecting a decrease. Their long-term expectations are moored to the 2% target.
Finally, we discussed the impact of increasing our policy interest rate. While we've been clear with Canadians that they should expect a rising path for interest rates, seeing their mortgage rates and other borrowing costs increase can be worrying. We will be assessing the impacts of higher interest rates on the economy carefully. We also discussed where rates might end up. How high will they need to go? I know many Canadians have the same question, so let me share the Governing Council's thinking. Canadians should expect interest rates to continue to rise toward more normal settings. By more normal, we mean within the range we consider for a neutral rate of interest that neither stimulates nor weighs on the economy. The neutral rate isn't something we can measure directly. We have to estimate it. And our estimate is between 2 and 3%. Today, we raised our policy rate to 1%, still well below neutral. This is also below the pre-pandemic policy rate of 1.75%. Il faut se rappeler qu'on a une cible d'inflation.
We must recall that we have a target for inflation. The Governing Council is not on autopilot. We do not have a predetermined direction for this level. The inflation level will depend on the economy and how inflation outlook evolves. We were entering a demand excess phase. The economy is growing and inflation is high. We are committed to bringing inflation down to the target.
Not an interest rate target. This means Governing Council is not on autopilot to a pre-established destination for the policy interest rate. How high interest rates will go will depend on how the economy responds and how the outlook for inflation evolves. The economy has entered this period of excess demand with considerable momentum and high inflation, and we are committed to getting inflation back to target. If demand responds quickly to higher rates and inflationary pressures moderate, it may be appropriate to pause our tightening once we get closer to the neutral rate and take stock. On the other hand, we may need to take rates modestly above neutral for a period to bring demand and supply back into balance and inflation back to target. We will, of course, be updating our views on the outlook for the economy and inflation as new data come in, and we will continue to share our assessments so Canadians can make informed decisions. Let me conclude with a brief word on quantitative tightening. We expanded our balance sheet during the pandemic, first to help restore financial market functioning and provide liquidity to the financial system, and then to add further stimulus to support recovery. Last November, we stopped increasing our holdings of Government of Canada bonds and have been in the reinvestment phase since then. Today, we announce we're entering the next phase, quantitative tightening, or QT. Effective April 25th, we will stop purchasing Government of Canada bonds to replace our holdings as they mature, so our balance sheet will shrink. This will put upward pressure on borrowing costs further out the yield curve, complementing the increases in our policy rate. And with that, let me stop here, and Senior Deputy Governor Rogers and I would be very pleased to take your questions. Thank you.
Merci, Monsieur le Gouverneur. Passons maintenant au période de questions. We will
go to questions.
Start with the reporters who we have here in the room before we go to those on the phone. For those on the phone, I'll just remind you to mute your line when you're finished answering the question, and do so by pressing *6. Unmute by pressing *6 again. Pour mettre votre ligne en mode discrétion, appuyez sur *6. Et pour
press *6 to unmute and *6 to mute.
So, as I said, we'll start here in the room. Let's do one question per reporter in this first round, please, and we'll see how we're doing on time. If I forget to do so, please state your name and affiliation. Et avant de poser une question, veuillez vous identifier et librez-vous, bien sûr, à poser
Identify yourself before asking your question, and
so let us begin with Steve Shearer from Thomson Reuters.
Good morning. I wanted to follow up and ask you, when you say that the interest rate, to return inflation to target, you will do so forcefully if needed, raise interest rates forcefully if needed. This was interpreted by the markets to mean 50 basis points in this move. Do you think that interpretation was fair? It seems that you have done exactly what the markets were expecting today.
Look, I'm going to let our words speak for themselves. Yes, we are prepared to move as forcefully as needed to get inflation back to target. We took an important step this morning. It's clear we have more work to do.
Next, let's go to Heather Scoffield of the Toronto Star, please.
Governor, I asked you a few months ago about Pierre Poilievre going out and talking about the Bank of Canada and the government working in tandem to drive up inflation. And you responded at the time that you weren't very concerned about it because inflation expectations were well anchored. They're not anchored as well anymore, and that discourse continues. And I wonder if you see any harm in that.
Well, as we look, the longer inflation remains well above our target, the greater is the risk that Canadians begin to think that this higher inflation is going to persist, and that becomes embedded in their inflation expectations. And the need to make sure that inflation expectations remain moored on our 2% target was reflected in our decision today. Much of the high inflation we're experiencing today is coming from international factors, and the war in Ukraine has pushed commodity prices higher. It's further already disrupted global supply chains, and that's the principal reason why our inflation forecast is revised up. As global supply chains begin, those pressures on global supply chains begin to ease, as oil prices stabilize and potentially start to decline, inflation in Canada will come down, provided inflation expectations remain well anchored on our target. And that wasn't the only reason, but that was certainly a factor in our decision today. The other part is that with an economy with considerable momentum, an economy that's moving into excess demand, our domestic inflationary pressures are also increasing. And the other key reason to raise rates today and to signal the need for further increases is that we need to bring demand and supply back into balance and bring inflation back to target.
Thank you. We'll go to Rahul Vedanath of Epoch Times, please.
you for taking my question. I guess it's a bit similar to the question that was asked. I mean, at the start of the pandemic, the government and Bank of Canada coordinated extraordinary monetary and fiscal policy to get inflation back up to 2%. And it was always, I guess it was said at the time that inflation would climb dramatically. So, and there have been other events that have exacerbated the situation. But in terms of, breaking down the inflation, like how much of it is, due to the extra fiscal policy, extra monetary policy, and, would budget 2022 have caused you to raise the inflation outlook at all?
You've packed a lot into that question. So let me try to.
Because I don't get a follow-up quite yet.
So let me. There's really two parts to it. First of all, I don't think I need to remind you that the last 2 years have been incredibly challenging. 2 years ago, we had roughly 3 million Canadians unemployed, and more than another 3 million working less than half their normal hours. Thanks to exceptional monetary and fiscal stimulus, thanks to effective vaccines, and thanks to the resilience of Canadians, we've seen a very impressive recovery in this economy. The labor market has now more than recovered from the pandemic. We are facing new challenges. We've experienced the sharpest decline in our economy we've also experienced the fastest rebound. And with that, global supply chains have not been able to keep up. They're clogged, they're impaired, and with the surge, particularly in demand for goods, you're seeing sharply higher goods prices. The war in Ukraine has further increased inflation in Canada and around the world. We've taken important steps. We've increased our interest rate today by 50 basis points to 1%. We've signaled that interest rates need to rise further. That will moderate spending growth in Canada. That will bring demand more in line with supply, and that will bring inflation back to target. And so I do think Canadians can be confident that we will control inflation. And if you look back over our 30 years of inflation targeting, there have been fluctuations in inflation before, and we've always brought inflation back to target. The fluctuations we're seeing now, yes, they are, bigger than we've seen in 30 years. Everything about this pandemic is bigger, but we are on a path, and that path will bring inflation back to target. With respect to the government's recent budget, a couple things. First of all, I'd mention that the latest budget is not incorporated in the projection we published this morning. The budget came out less than a week ago. But what I can say is that the net new measures in the budget are about $30 billion over the next 5 years. That is certainly a positive impulse. But it's not on a scale that would materially affect our projections. We remain confident in our inflation and GDP projections. I think the budget could have a bit more effect on some of the components, but at aggregate level, we remain confident in our forecast. As you know, what we do is we take, whether it's provincial or federal government fiscal plans as given, and we put those into our projections. Our job is to control inflation, and that's what we're focused on. And the policy decisions we took this morning reflect that.
Our next question comes from Greg Quinn of Market News. Greg.
Good morning. I'd like to follow up on something Heather asked. I think specifically conservative lawmakers have used phrases such as saying you've printed money, bankrolled inflationary budget deficits. You still are just turning to a passive roll-off of bonds on the books. generally, is it a fair critique from the Conservatives? And specifically, would it not be a good idea to bring inflation down faster by putting those bonds back into the market and getting them off your books?
Well, with respect to quantitative easing, we are stopping buying Government of Canada bonds. The bonds we have in our balance sheet, the maturity structure of those is relatively short term. So we will see a fairly marked runoff of our balance sheet over the next 2 years. Roughly 40% of the bonds on our balance sheet will mature over the next 2 years. So with a fairly good runoff, at this time, we don't see the need to actively sell bonds.
We'll now go to Paul Vieira from the Wall Street Journal.
Governor, the real estate sector and housing has been a major driver of growth over the last little while. Yet you anticipate housing to be a drag on growth, but you expect other parts of the economy to pick up the slack. Do you think your assessment of how much housing will slow? How did you come to this? Expectation about the amount housing will slow? And are you confident that exports and business investment will pick up the slack, given that your predecessor used to talk about serial disappointment or something along those lines?
I'm going to bring Senior Deputy Governor Rogers in here.
Thanks, Paul, for the question. So our expectation on housing activity is that it will moderate over time, particularly as interest rates come up. We should remember that it's starting from an extremely elevated level. So even as it moderates, we still think it will stay high. We don't think this will have a big drag on the economy. Certainly, we have talked for quite a while about the risk that elevated house prices bring along elevated debt levels. Elevated debt levels can bring a vulnerability to the economy, particularly in a rising rate environment. So that's something we'll watch carefully. We think there's a number of things that'll sort of offset that. One is that over the course of the pandemic, household balance sheets have improved. People have paid down debt. They've increased their savings. That will give them a buffer against rising rates, rising mortgage rates, rising interest rates more generally. We should also remember that rates are coming from a very low point. So, and there's been macroprudential policies in the market for a while now that borrowers for mortgages are stress tested against a higher interest rate. So there's some distance to go between where mortgage rates are now and that higher rate. So that again will buffer households against increases in mortgage rates. So just to summarize, we think, as the governor said in his opening statement, we think the economy needs higher interest rates, including higher mortgage rates, and we think that the economy can withstand them. In terms of whether business investment will pick up, I don't know that we're looking at it as an offset to the housing market, but what we are hearing from businesses is that there is a stronger intention to invest. As the economy recovers, the pandemic health restrictions come off, there is that optimism, that momentum behind the economy, and we are expecting to see some business investment pick up.
Our next question is from Kevin Carmichael of the Financial Post.
Governor, commodity prices have taken off, but the exchange rate really hasn't. Has the traditional link between commodity prices and the dollar broken down, and would a higher exchange rate be helpful at a time like this?
Kevin, well, as you well know, we don't have an inflation target. We don't have an exchange rate target. We have an inflation target. We don't even have a forecast for the Canadian dollar. In our own projection, we keep the value of the Canadian dollar constant near iets current level. I think it's 79 cents in this projection. What I can say is as you suggested, historically, when energy prices have moved up a lot, you have seen some appreciation of the Canadian dollar. We haven't seen as much of that, and that has some implications. When the Canadian dollar moves up with higher oil prices, it provides a bit of a buffer. It reduces the Canadian dollar price of that increase in global oil prices. We're not getting that this time, so the inflation impulse is bigger. For commodity producers, though, their Canadian dollar income has actually increased by more because it's not being offset by the appreciation. In terms of trying to understand the Canadian dollar, and this is certainly, I'm going to leave it to markets to really determine the value of the Canadian dollar. I think one element is oil prices have gone up a lot, but clearly part of this is caused by the war. Hopefully the war ends soon and those come down, and I think that's what many producers are expecting. Certainly when you talk to them, they're planning on lower prices than today. So we're not getting as much of an investment boom. They also may be looking longer term to the transition to zero carbon growth. So we're not getting as much of an investment response from the oil patch. We are certainly getting some investment response, but not as much as we have historically.